Stop scrolling. If you're on Social Security or if you're planning to be on Social Security someday, you need to hear this right now because 4 changes have just been announced and most people have absolutely no idea they're coming. And here's the thing. Some of these changes could put more money in your pocket, and some of them could quietly reduce what you're expecting to receive. Either way, you need to know what's happening before it affects your bank account. So stay with me for a few minutes because I'm going to walk you through every single one of these changes in plain English, no confusing government language, no complicated jargon, just a clear, honest conversation about what's changing, why it's changing, and exactly what you need to do about it. Let's start with a little bit of background because I think it helps to understand why Social Security keeps changing in the first place. Social Security was never designed to be a static program. It was built back in 1935, and since then it's been adjusted, updated, and overhauled dozens of times. The Social Security Administration, the SSA, makes regular adjustments based on things like inflation, wage growth, the overall economy, and of course changes in federal law. Sometimes those adjustments are small and barely noticeable, but sometimes, like right now, they're big enough that you genuinely need to pay attention because they can change your monthly check, your eligibility, or even how you apply for benefits. And in 2026, we're seeing a combination of changes that, taken together, represent one of the more significant shifts in recent memory. So let's get into it. The first change, and this is the one that's going to affect the most people, so I want you to really stay with me here, is the new cost of living adjustment, or COLA, for 2026. Now, if you've been following Social Security news at all, you already know that COLA is basically the annual raise that Social Security recipients get to help keep up with inflation. Every year, the SSA looks at something called the Consumer Price Index for urban wage earners and clerical workers, which is just a fancy way of measuring how much everyday things like groceries, gas, and utilities are costing people. And based on that number, they calculate how much your benefit should increase. Here's what a lot of people don't realize. The COLA doesn't just apply to retirement benefits. It applies to Social Security Disability Insurance, SSDI, and Supplemental Security Income, SSI, as well. So if you're receiving any form of Social Security payment, this change touches you. For 2026, the COLA has been set at 2.5%. Now, I know some of you are thinking, is that good or bad? And the honest answer is, it depends on your situation. Compared to the massive 8.7% adjustment we saw back in 2023 when inflation was really out of control, 2.5% sounds modest. But compared to years when the adjustment was close to zero, it's actually pretty meaningful. Let me put that in real numbers so it makes sense. If you're currently receiving $1,800 a month from Social Security, a 2.5% increase means your check goes up by $45 a month. That's $540 more per year just landing in your account. Now, if you're receiving $2,500 a month, you're looking at a $62.50 monthly increase, which works out to $750 more over the course of the year. Those aren't life-changing numbers on their own, but when you're on a fixed income and every dollar matters, and I know for a lot of you, every dollar absolutely matters, that extra money makes a real difference. It helps cover the rising cost of prescriptions or groceries or that heating bill that seems to get bigger every winter. But here's the catch, and this is important. Your actual take-home increase might be a little different from what the math suggests. That's because Medicare Part B premiums, which are deducted directly from most Social Security checks, also tend to go up each year. So while your gross benefit might increase by $45, if your Medicare premium goes up at the same time, your net increase could be smaller. The SSA calls this the hold harmless rule in some cases, but it doesn't apply to everyone equally. My strong advice is to look carefully at your official COLA notice when it arrives, or check your My Social Security account online, and make sure you understand exactly what's changing on your check, not just the headline number. Now let's talk about the second change, because this one is a big deal for anyone who's still working while receiving Social Security benefits. It's called the Earnings Test Exempt Amount, and I'll explain this in plain English because the name itself is a little confusing. Here's the basic idea. If you're under your full retirement age and you're collecting Social Security but you're also still working and earning income, there are limits on how much you can earn before the SSA starts temporarily reducing your benefits. They're not taking the money away permanently, but they will hold back some of your payments if your earnings go above a certain threshold. In 2026, those thresholds have increased. If you are under full retirement age for the entire year, You can now earn up to $2,220 before any reduction kicks in. That's up from the previous limit. For every $2 you earn above that amount, the SSA will withhold $1 in benefits. Now, I want to be really clear about something here, because this is where a lot of people get confused and sometimes even panicked. This is not a permanent penalty. The money they withhold gets added back to your benefit later, once you reach full retirement age. They recalculate your benefit and give you credit for those withheld payments. So it's more of a temporary delay than a real loss. But it does affect your cash flow in the short term. And if you're counting on that monthly check to cover your bills, you need to know what your earning limit is. If you're reaching full retirement age in 2026, meaning you'll hit that milestone sometime during the year, the rules are a little different and actually a little more generous. In the months leading up to your birthday month when you reach full retirement age, you can earn up to $59,520 before the withholding kicks in, and at that higher level, they only withhold $1 for every $3 over the limit instead of 1 for every 2. And then the month you actually reach full retirement age, the earnings test goes away entirely. You can earn as much as you want, work as much as you want, and your Social Security benefit won't be affected at all. That's an important milestone, and if you're close to it, it's absolutely worth knowing. Now let's move to the third change, and this one affects people who are still building towards Social Security, not just those already receiving it. I'm talking about the Social Security taxable wage base, sometimes called the contribution and benefit base. This is the maximum amount of your income that's subject to Social Security payroll taxes each year. In 2026, that cap has increased to $176,100. What that means in practical terms is that if you earn up to $176,100, every dollar of that income is subject to the 6.2% Social Security payroll tax, or 12.4% if you're self-employed and paying both the employee and employer share. Any earnings above that ceiling are not taxed for Social Security purposes. Now, here's what a lot of people don't realize, and let's take a step back for a second to appreciate why this matters. When this cap goes up, it means higher earners are contributing more into the Social Security system. That's actually by design. The taxable wage base is indexed to average wage growth in the economy, so as wages rise over time, the cap rises with them. But here's the flip side. If you're a high earner, this means slightly more of your paycheck is going towards Social Security taxes in 2026 compared to 2025. For most middle-income workers, nothing changes. Your wages are well below the cap either way. But for business owners and self-employed individuals earning over that threshold, this is real money worth accounting for in your tax planning. And speaking of business owners and self-employed folks, the fourth change is one I really want you to pay attention to, because it often gets buried in the news and most people completely miss it. This is a change related to Social Security credits, specifically the earnings required to earn 1 work credit in 2026. Here's the background. To qualify for Social Security retirement benefits, you generally need 40 work credits, which roughly translates to about 10 years of work. You can earn up to 4 credits per year, and the amount of income you need to earn each credit goes up slightly most years. In 2026, you now need to earn $1,110 to receive 1 Social Security work credit. That's an increase from the previous threshold. Why does this matter? Well, for most full-time workers, this is a non-issue. You'll easily earn your 4 credits in a year without even thinking about it. But for people who work part-time, who are in and out of the workforce for family caregiving reasons, who are seasonal workers, or who are self-employed with variable income, this is actually something to be aware of. If you're trying to accumulate credits toward your eventual retirement benefit or toward disability benefit eligibility, and your income is on the lower end, you want to make sure you're hitting that threshold each year, because a missing year of credits can sometimes affect your benefit calculation down the road, even if only slightly. It's one of those small details that can add up over a lifetime. And while we're talking about benefits and eligibility, I want to take a moment to talk about something that doesn't get discussed nearly enough: scams. Because every single time there's a major announcement from the Social Security Administration, scammers go to work. They know that people are searching for information, people are nervous, people are confused, and they exploit that. So let me be very direct with you. The Social Security Administration will never call you on the phone and demand immediate action. They will never threaten to suspend your Social Security number. They will never ask you to pay a fee to receive your benefits, and they will never ask you to provide your personal information over an unsolicited phone call or text message. If you receive any kind of communication like that, hang up. Don't engage, don't argue, don't give them a single piece of information. If you're ever unsure whether a communication is legitimate, go directly to the official Social Security website at ssa.gov or call the official SSA number at 1-800-772-1213. Those are the only two channels you should trust. Scammers are getting increasingly sophisticated, and they specifically target Social Security recipients because they know these are often people who depend on their benefits and can be frightened into making quick decisions. Don't let that be you. So now let's talk about what you should actually do with all of this information, because knowledge is only useful if you put it into action. First, if you don't already have a My Social Security account set up online at ssa.gov, I want you to do that today. Not tomorrow, today. Your online account is where you can see your complete earnings history, check your projected benefit at different retirement ages, see your COLA notice when it comes out, and track any changes to your benefit amount. It's free to set up, it takes about 15 minutes, and it is genuinely one of the most important things you can do to stay in control of your financial future. Second, if you're still working and receiving benefits, take a few minutes to calculate where you stand with the earnings test. Add up what you've earned or what you expect to earn this year, compare it to the new $22,320 threshold, and make sure you understand what your situation looks like. If you're close to that limit, it might be worth a conversation with a financial planner or a Social Security specialist, because sometimes the timing of when you claim benefits relative to your work schedule can make a meaningful difference. Third, if you're self-employed or a business owner, loop in your accountant about the new $176,100 taxable wage base, so it's accounted for in your quarterly tax planning. It's a small but real change that affects how much you owe, and surprises are never fun at tax time. And finally, and this one is for the people who are maybe a few years away from retirement and haven't yet done a deep dive into their Social Security strategy, please don't wait. The decisions you make about when to claim Social Security, how to coordinate it with a spouse's benefit, and how to factor it into your overall retirement income plan can literally mean tens of thousands of dollars over your lifetime. These aren't minor details. The difference between claiming at 62 versus waiting until 70 can be as much as 76% in your monthly benefit amount. That is enormous. And the changes happening in 2026 make this a particularly good time to revisit your plan and make sure it still makes sense. Here's the bottom line. Social Security is changing. It always is. And the 4 changes we talked about today are real. They're confirmed, and they are already affecting people right now. The COLA increase is putting a little more money in your pocket each month. The updated earnings limits are giving working beneficiaries more room to earn. The higher taxable wage base is affecting how much higher earners contribute. And the updated credit threshold is a quiet but important shift for part-time and self-employed workers. None of these changes should scare you, but all of them deserve your attention. Don't leave money on the table. Don't let confusion or procrastination cost you what you've earned over a lifetime of work. Check your My Social Security account. Review your benefit statement, and if anything in today's video raised a question for your specific situation, please talk to someone who can give you personalized guidance. And if you found this helpful, if any part of this clicked for you in a way it hasn't before, please share this video with someone you care about, a parent, a sibling, a friend who's getting close to retirement age. Because this information matters, and too many people find out about these changes too late. Stay informed, stay protected, and I'll see you in the next one.